Welcome to The Explainer. You know, the tax landscape is shifting once again, and getting a firm handle on these new 2026 rules, it's absolutely the best way to keep more of your hard-earned money. So whether you're right in the middle of your prime earning years or looking right at the finish line of retirement, let's just dive right in and break down exactly how your money is taxed, saved, and eventually withdrawn.
Here's a quick look at our roadmap for today. We'll hit 2026 taxes and deductions, maximizing your Roth IRA, those tricky Roth withdrawal rules, navigating your RMDs, and finally, some real strategies to lower your taxes.
All right, let's kick things off with Section 1, 2026 Taxes and Deductions. This is all about setting our baseline.
Okay, so your starting line for 2026 is $32,200. That is the brand new standard deduction for married couples filing jointly, which comes directly from recent legislative adjustments. If you're single or married filing separately, that number sits at $16,100, and for heads of household, it's $24,150. Think of this as the amount of income you get to earn completely tax-free before you even start calculating your federal income tax.
Now, when we look at the updated 2026 brackets, you can see exactly where the progressive tax thresholds are set. The U.S. system is a graduated ladder. It starts at a 10% rate for single filers, making up to $12,400, steps up incrementally from there, and cops out at the top marginal rate of 37% for single incomes over $640,600. The big takeaway here, you do not pay your top rate on every single dollar you earn. You literally only pay it on the dollars that spill over into that specific bucket.
Let's look at how the math actually plays out in the real world. Say you're a single filer with a taxable income of $65,000. Now that income technically pushes you into the 22% tax bracket. That's your marginal rate. But wait, you only pay 10% on your first $12,400, then 12% on the next chunk up to $50,400, and you only pay that higher 22% on the remaining $14,600. So when you total it all up, your federal income tax is $9,012. Divide that by your total $65K income and your blended effective rate, it's actually just 13.9%. Grasping the difference between those two rates is a massive game changer for your financial planning.
Moving right along to Section 2, maximizing your Roth IRA, or how to really shelter your wealth.
So here's the deal with the Roth IRA. While you don't get a tax deduction today when you put the money in, you are locking in completely tax-free growth and tax-free withdrawals for your future. You're essentially paying the taxman right now at your current effective rate, making a bet that your future tax rate might be higher, and letting decades of compound interest just snowball, entirely shielded from the IRS. It's a pretty incredible tool.
Let's talk 2026 contribution limits. If you're under 50, you can stash away up to $7,500 this year. If you're 50 or older, a catch-up provision lets you bump that up to $8,600. But you've got to pay attention here because your eligibility is tied directly to your income. For single filers, your ability to contribute starts phasing out at $153,000 and completely vanishes at $168,000. If you're married filing jointly, that phase-out window hits between $242,000 and $252,000.
Okay, Section 3, Roth IRA withdrawals rules. How do you actually access your money? When you want to take Roth distributions, the IRS uses a strict first-in, first-out rule. And honestly, this is fantastic news for you. It means that whenever you pull money out, you are always pulling out your own after-tax regular contributions first. And those, they are totally tax-free and penalty-free anytime. Once you've emptied those out, you start tapping into any conversions and rollovers you've done. You only touch your actual investment earnings at the very, very end.
But keep this in mind. While you can pull those original contributions out whenever you want, getting your investment earnings out tax-free means you absolutely have to pass a strict two-part test. First, the account has to have been open for at least 5 tax years. That's the famous 5-year rule. Second, you have to hit a qualifying condition, like reaching age 59 and a half, becoming permanently disabled, or using up to $10,000 for a first-time home purchase. If you miss either of those requirements, you're going to get slapped with income taxes on those earnings, plus a nasty 10% early withdrawal penalty.
Now look, life happens. And if you absolutely must tap into those earnings early, the IRS does offer some specific life event exceptions to help you dodge that painful 10% penalty. You can pull up to $10,000 for a first home, $5,000 for birth or adoption expenses, up to $22,000 for federally declared disasters, or even a quick $1,000 for personal emergencies. Just remember, you'll still owe standard income tax on the earnings, but you successfully avoid that extra 10% penalty hit.
So what happens when you turn 73? Well, that specific age brings us to a huge turning point in your financial timeline. Turning 73 is the magic number where the government officially forces you to shift from your saving years right into your mandatory withdrawing years for any pre-tax account.
Which brings us to Section 4, navigating your RMDs. These are the endgame rules.
Turning 73 puts you on a very rigid schedule. The moment you hit that age, you have to take your first required minimum distribution, or RMD. Now, the IRS is a little generous at first. They give you a grace period until April 1st of the following year for that very first distribution. But watch out, because here is the trap. If you delay that first RMD to April 1st, you still have to take your second RMD by December 31st of that exact same year. Taking 2 distributions in a single calendar year can easily spike your taxable income and push you right into a higher tax bracket.
And let me tell you, missing an RMD deadline is incredibly costly. If you forget, or if you just calculate the amount incorrectly, the penalty is a staggering 25% of the amount you were supposed to withdraw. The good news, if you catch the error quickly, take the withdrawal, and file an IRS Form 5329 with a letter of explanation, they might drop that penalty down to 10%. But honestly, your best bet is to just automate this process so you never miss a deadline.
If you're managing multiple accounts, aggregating these RMDs can get a little tricky. You do have to calculate the RMD for each account separately. But for traditional IRAs, you're allowed to combine the total and pull the entire sum out of just one IRA. You can do the exact same thing with 403Bs. What you cannot do is combine 401Ks or 457Bs. Each of those legally requires its own separate withdrawal. Oh, and the absolute best part of all this? Roth IRAs have 0 RMDs during your lifetime, period.
All right, our final stop, Section 5, Strategies to Lower Taxes. Basically, keeping what's yours.
Now that we've mapped out the rules of the maze, let's look at 3 highly effective strategies to minimize your tax shock. First up, Roth conversions. This is where you intentionally move pre-tax money into a Roth, paying the taxes today at what are hopefully lower rates, all to shrink your future RMDs. Second, qualified charitable distributions, or QCDs. If you're charitably inclined, you can donate up to $111,000 in 2026 directly from your IRA to a qualifying charity. It instantly satisfies your RMD and doesn't count as taxable income. Pretty sweet. Third, planned early withdrawals. This means strategically tapping your tax-deferred savings before age 73 just to bring the overall balance down, which ensures your required distributions later in life stay manageable.
Getting a handle on these IRS rules isn't just dry financial trivia. It is literally the foundation of keeping your money in your pocket. The difference between passively letting the tax code dictate your retirement versus actively using tools like Roth IRAs, precise withdrawal sequencing, and RMD mitigation, that can literally mean hundreds of thousands of dollars saved over your lifetime. And that leaves us with a critical thought to wrap up today. The life cycle of your money is completely manageable if you just stay informed and proactive. So, now that you've seen the 2026 brackets, the incredible advantages of the Roth, and the potential cliffs of RMDs, how are you going to use this explainer to sit down with an advisor and optimize your own retirement roadmap? The rules are set, so start planning today and go take control of your financial future.